The difference between having an 80% win rate and a 90% win rate is massive. Over time, the difference is the gap between barely making money and being able to trade options for a living. And if you're already trading options and you feel like you're doing a lot of things right, but you're still not winning enough trades, then this video will definitely help you. Even with a bad trading strategy, focusing on selecting the right stocks to trade is a game changer. Most traders think that the best way to make more money is to trade more. That's a mistake, and the opposite is actually true. I'm a private investor, which means I make a living investing my own money. I don't have a boss, I don't sell anything, and if I don't make money in the market, I don't have any income. So what I'm going to show you now is how I personally increase my win rate from 75% to 85% on my probability-based credit spread option strategy. The reason I believe credit spreads are one of the safest, most reliable ways to trade options is because they're probability-based. I'm not trying to predict the market or direction. I'm not guessing what the economy will do. I'm simply playing the odds. That makes option trading much more structured and scalable. My strategy breaks even at a 70% win rate. At 75% win rate, I'm profitable. But at 85% or higher, that's when the real money is made. And here's the key point. You don't go from 75% to 85% by trading more or by taking more risk. You get there by doing the exact opposite. Trading less, reducing risk, and avoiding bad trades. Avoiding bad trades is the key to winning more. Being selective is what moves the needle. And here's exactly how I do it. My entire decision process has 3 steps. Step 1, market conditions. Step 2, stock conditions. And step 3, option pricing. If any of these fails, I don't trade. No exceptions. Step 1, market conditions. The first thing I check every single day is the VIX. When it's high, investors are nervous. And nervous markets tend to produce large, unpredictable swings. I don't like big swings. My strategy does not perform well in those conditions. So if the VIX is above 20, I simply do nothing. I stay out of the market, I'll take the day off, do something completely different with my day. Next, I check the SPY. The SPY tracks the S&P 500. It's an ETF. If SPY is trading above its 50-day moving average, then the market trend is healthy. If SPY is below the 50-day moving average, that's a sign of weakness and a sign that we are in a downtrend. I don't trade against the overall market. I don't trade against trends. So if SPY is below the 50-day SMA, I'm going to take the day off. I'm not going to place any trades because I don't want to trade in a downtrend. If the market is not supporting your strategy, you have to walk away. Step 2, stock conditions. Once the market conditions are confirmed, I move on to individual stocks. The first indicator I look at is the RSI. The RSI doesn't predict the future. It simply tells me whether a stock is currently hot or cold. For my strategy, I don't want stocks that are too hot. I'm looking for stocks that are slightly below the median because I expect that they will revert towards the middle again eventually. And because I'm using credit spreads, I don't need to be perfect on directions or my timing. That's one of the huge reasons why credit spreads are so good. I usually have room for the stock to move 5 to 10% against me and I'll still win my trade. Credit spreads give you room to be wrong. I also check the moving averages on each stock because this helps me decide if a stock is in an uptrend or in a downtrend. I'll never trade a stock below the 50-day SMA, and I like to see the stock above its 20 days SMA, though it's not a hard requirement. These averages tells me whether the stock is in an uptrend or in a downtrend, and I don't trade against the trend. So the perfect setup is simple. A stock in a solid uptrend that's already had a small pullback and now has room to move back up towards the median over the next 2 or 3 weeks. Next, I take a look at the option chain and I ask one simple question. Am I getting paid enough for the risk I'm taking? I'm looking for a credit spread where the delta is below 25 and where I can collect at least $4 in credit on a $20 wide spread. If I can't get the $4 on a 20 wide spread, then I don't take this trade. No premium, no edge, no trade. Most days, there's a handful of stocks meeting my selection criteria. So instead of guessing, I rank the different trading options. I use a Google Sheet that assigns each potential trade with a score from 0 to 100. The score is based on the distance from today's price to the short strike, the RSI, the amount of credit received, and the stock's volatility. Because I don't need to take every trade. I just want those trades that has the highest probability of winning. I want to increase my win rate. I don't want to just trade for the sake of trading. I only want the best ones. So once the sheet ranks them, I usually just take number 1. No emotion, no guessing, no predicting. If my sheet rates a trade with more than 70, then I'll take the trade. If it rates it below 70, then I'm not interested. I'll wait till tomorrow and see what else pops up. If you want this sheet, hit the like button and I'll share a link to the sheet in the comments below. Now let's take a look at my rating sheet and let's play the real trade. One of the highest rated stocks today is Light. So let's take a look at the chart. It's above the 50-day SMA, which is exactly what I want. The RSI is around 51, which tells me that this stock is not overheated. This is on the cooler side. That's what I like. We can see that the stock has been in an uptrend since November. It just had a small pullback since January. This is really a textbook setup. So now I want to go to the option chain because I want to check that I can get enough credit. I have to choose between 2 different expiration days here. I already have a bunch of trades expiring in February. So in order to spread out my risk a little bit, I think for this trade, it's smarter to go with March. And now I'm just playing around with the different strike prices because I want to find the lowest possible delta I can select and still receive my $4 in credit. The lower delta, the lower risk. In this case, I'm actually able to get a delta of 14, which is crazy low. And I collect $4.05 in credit. This trade meets all my criteria, so I place the trade, and now it's time to log it in my little sheet with all our other trades. You notice all my trades look very similar in terms of risk and reward. That's intentional, because consistency is everything if you want to be profitable trading options. And now, let's check in on our tested trade from the last video. At entry, the delta was around 22, which means that my probability of winning this trade is 78%. When we're looking at the spread now, we can see that the delta has decreased to 15 and the probability of profit has increased to roughly 84%. If I close the trade today, I'll make about $135 in profit. But my profit target is $200 per trade. So nothing to do here. I'll just have to give this trade a little bit more time. And if we're lucky enough, I'm going to be able to close it in my next video. And this is how you move from an average win rate to a very high win rate. Not by trading more, not by taking more risk, but by being selective and letting probability work only when conditions are right. Be smart about how you choose what to trade. Never just jump on a stock that you heard about in the news. If you want updates on these trades and more information on my strategy that I'm using as a professional investor, make sure you subscribe to my channel. In my next video, I'll compare credit spread to cash secured puts, and I'll tell you why you should never trade a cash secured put. And remember, this is not financial advice. I'm not a financial advisor. This is for your education only. I'm just telling you what I'm doing. Don't do anything stupid, please. So please subscribe and come back and watch my next video. Thank you for watching.